Welcome to the deep dive, the place where we take these, incredibly complex legal and financial documents, and we really try to pull out the most important things for you. Today, we are tackling what I think is, well, it's the Mount Everest of Canadian estate planning, the family trust.
Oh, absolutely. It is essential, and I think we have to start by just saying how intimidating this all sounds. A family trust is, it's an incredibly powerful tool.
The ultimate tool, really.
It is for preserving wealth, for control, and for some very strategic tax planning. But that power, it comes with a lot of complexity.
Hmm.
We're dealing with legislation from the CRA that is, it's intentionally designed to catch people.
Right, to catch the missteps.
Exactly. And those missteps aren't just a headache. They can be massive, immediate tax bills.
And that's exactly the challenge we're taking on today. Our mission is to give you a complete plain language blueprint. We want to cover the basic legal structure, the strategic why behind it, why you'd even bother with the expense.
And the costs, the real costs.
Yeah, the real costs, and maybe most importantly, those terrifying tax tripwires like the 21-year rule. The goal is that by the end of this, you'll be able to ask your own advisors the right questions.
And to really understand what they're telling you, we just need to be clear from the start. A family trust isn't like a bank account. It's not a TFSA. It's a very rigorous, very demanding legal agreement that needs constant attention.
Okay, so let's start right there at the very beginning. What is this thing, legally speaking?
Well, the classic legal definition is a relationship of obligation recognized in equity.
Which sounds very much like a lawyer wrote it.
It does. So in practical terms, think of it as a customized rulebook. That rulebook is a legal document called the trust deed, and its entire job is to legally bind one person to hold assets for the benefit of another.
And the absolute genius of it, the reason it works, is this idea of separating ownership.
That's the engine of the whole thing.
Yeah.
You legally split ownership into two pieces. First, you have legal ownership.
Okay, who holds?
That's held by the trustee. They're the manager, they're on title. But then you have beneficial ownership,
Yeah.
and that's held by the beneficiaries,
Yeah.
the people who actually get to enjoy the assets.
So the manager has control but can't benefit, and the beneficiaries can benefit but have no control.
Precisely. That separation is what gives you all the power for asset protection, for tax planning. But to make it work, you need four distinct players in this structure.
Let's start with the person who pushes the button to start it all, the creator.
That's the settlor. The settlor is the person who brings the trust into existence by transferring a very small nominal amount of money to the trustee. We're talking $10, maybe $100.
Just a token amount.
It's a token amount, but it's legally critical. Without that first transfer of property, there is no trust.
Now, here's something that I think trips a lot of people up. If I'm setting this up for my family with my money, the advice is that I shouldn't be the settlor. Why is that? Why does it need to be, a friend or a lawyer?
It's a necessary bit of legal choreography. It's all about neutralizing the CRA's attribution rules. We'll get into the details later, but basically, if you transfer property to a trust for your spouse or your minor kids, the income can be taxed back to you.
So if I'm the one who puts in the $10 and then I also put in the millions of dollars later, the CRA can draw a straight line.
They can't. It creates a direct link that can trigger those rules. So by using an arm's-length person, your accountant, your lawyer, to put in that first symbolic $10, you create just enough legal distance. It's a fiction, but it's a necessary one.
Oh, so the settler's job is done in 5 minutes. Now we get to the person actually steering the ship, the trustee.
Right. The trustee holds that legal title. They are the official manager.
And what's the weight of that responsibility? It sounds heavy.
It's immense. It's governed by what's called a fiduciary duty, which is the absolute highest legal standard of care there is. It means they have to act honestly, in complete good faith, and only in the best interest of the beneficiaries.
They're totally bound by that rule book, the trust deed.
100%. And they are legally liable. For example, there's the prudent investor rule.
What does that mean in practice? What would a breach look like?
So let's say the trust has $5 million in stocks. A prudent investor would diversify. But say your trustee decides to put $4.5 million of that into one single high-risk tech stock because they have a good feeling about it.
And then it crashes.
And then it crashes. Even if their intentions were good, they breached their duty of diversification and prudence. The beneficiaries can, and frankly should, sue that trustee personally to recover the losses.
Wow. Okay, so that really underlines why choosing your trustee is so critical. It's maybe not a job for your well-meaning but financially inexperienced cousin.
It's often a job for a professional or a corporate trustee, exactly.
All right, so then we have the people. The whole thing is four. the
The
beneficiary.
family members, right? Your kids, your spouse, your grandkids.
Mhm.
They hold the equitable interest. They're the ones who are entitled to receive distributions.
And a key word here that I see in all the documents is discretionary. Most of these are discretionary trusts. What does that mean for the beneficiary?
It means they have no automatic right to get anything. The trustee has the full power, the discretion, to decide who gets what and when they get it.
And that's huge for asset protection, right?
It's the whole ball game. If a beneficiary can't legally demand the money, then their creditors can't easily claim it either. Or an ex-spouse in a divorce. The asset isn't technically theirs to lose.
Okay, there's one last role, which is sort of the ultimate control lever,
Hmm.
the appointer. Why is this person so important?
Because the person who created the wealth wants to maintain ultimate control without having the legal liability of being the trustee. The appointer, or sometimes called the pointer, doesn't manage the money day to day,
But they have one huge power.
the biggest power. They can hire and fire the trustees. So if the trustee is acting imprudently or the family situation changes, the appointer can just remove them and put a new one in place. It's the ultimate safety valve.
It's how you can sleep at night, knowing you still have control over who is managing your legacy.
Exactly.
Okay, so we have the players. But for this whole thing to even be considered valid by a court, there are three technical legal requirements, the three certainties. This sounds like where the DIY approach goes completely off the rails.
It's where it collapses. If your lawyer misses any one of these, the trust is void. It's like it never existed. And that can trigger a massive immediate tax problem.
So what's the first one?
Certainty of intention. The trust deed has to be crystal clear that you intend to create a trust. You can't use vague language like, I hope my kids use this money well. It has to be a command. The trustee shall hold this property.
No ambiguity. What's number two?
Certainty of subject matter. The assets have to be clearly identified. You can't just say, my fortune. You need to list the account number, the legal description of the real estate, the exact number of shares in the private company.
It has to be precise.
Utterly precise. And the third is certainty of objects. The beneficiaries have to be clearly ascertainable.
So saying my children or my issue works. What doesn't work?
My favorite relatives or my good friends. It's
Mhm.
too vague. A court has no way of knowing who that is. And if the court can't figure out who the beneficiaries are, the whole structure fails.
And the assets just go back to the original owner?
They revert back, which triggers that huge capital gains tax bill we were trying to manage in the first place. It's a complete disaster. This is why you need a specialist lawyer.
Right. So that establishes just how complex this is. So let's get to the big question. Why would anyone go through all this trouble and expense? What can a trust do that a simple will just can't?
Well, the why is actually overwhelming for the right kind of situation.
Mhm.
The number one reason is control and conditional distributions. A will basically just dumps the assets on your beneficiaries at a certain age,
Usually all at once.
all at once. A trust lets you manage that wealth across decades. You can build in conditions. For example, you can say funds can only be used for education until age 25.
Or you could phase the capital release.
Exactly. Say 20% at age 25, another 30% at age 35, and the rest at 45. It's a way to manage, potential spendthrift habits or just immaturity. It protects the capital from them and protects them from the capital.
That makes sense. Now, what about the most immediate, tangible financial win? I always hear about probate avoidance.
Oh, it's huge, especially in provinces with high probate fees like Ontario or BC. Probate is the public, court-based process of validating a will. It's slow and it's expensive.
And a trust just sidesteps it.
Completely, because the trust already owns the assets, not you. So on your death, there's nothing to probate. You save time. Probate can take a year, even two, and you save money.
How much money are we talking about?
Well, probate fees can be up to 1.5% of the estate's value. So on a $5 million estate, you could be saving $75,000 in fees right off the top. That alone can pay for the trust setup many times over.
And there's another benefit tied to probate being a public process, confidentiality.
This is non-negotiable for business owners or just private families. A probated will is a public document. Anyone can go to the courthouse and look up who got what.
Your competitors, your neighbors.
Anyone. A trust deed, on the other hand, is completely private. The assets, the beneficiaries, the terms. Nobody sees it except the trustees and their advisors.
Okay, let's talk about the shield aspect. Asset protection. How does a discretionary trust protect assets from a beneficiary's creditors or a future divorce?
It goes back to that word discretionary. Because the beneficiary has no guaranteed right to the capital, They can't be legally forced to give it up. A
Right.
creditor can't seize what the beneficiary doesn't technically own or control.
As long as the trust was set up well in advance and not, to hide money from an existing problem.
Right, you can't do it with the intent to defraud creditors,
Mm.
but as a long-term planning tool, it's incredibly powerful.
And finally, what about while I'm still alive, but maybe not well? Leaving incapacity. A will doesn't help me there, does it?
A will does nothing until you die. A trust is active from day one. If you become incapacitated, the trust deed will already have a clause naming a successor trustee. They can step in immediately and manage everything.
So no need for a slow, expensive court application to get a guardianship order.
Exactly. It provides seamless continuity when your family needs it most. No frozen assets, no delays.
So the case is pretty clear. You're trading simplicity for a massive amount of control, privacy, and protection.
And potentially huge tax efficiency.
Okay, so if you're convinced, we have to talk about the cost. This is not a cheap process. Let's walk through the roadmap to get one set up and then talk about the real numbers.
It's a 7-step process, and it absolutely requires a coordinated team.
Step 1, consult professionals.
Non-negotiable. You need an estate planning lawyer who specializes in this, and you need a tax advisor, a CPA, to analyze the tax consequences. They have to work together from the very start.
Step 2, draft the trust agreement. And these are almost always drafted as irrevocable, right?
Right. And that's a huge commitment. Irrevocable means you can't easily change it later. You'd have to go to court for a variation of trust, which is a massive, expensive legal undertaking with no guarantee of success.
So you have to get it right the first time.
We have to try and anticipate the next 50 years.
Okay, step 3 is appoint roles. You formally name everyone. Step 4 is the technical activation, the initial contribution.
That's where your lawyer friend gives the trustee $10 and poof, the trust legally exists.
Then step 5, the first bit of real admin work, open trust accounts.
The trustee has to go to the CRA and get a separate tax number for the trust. It's its own taxpayer. Then they open bank accounts and investment accounts in the name of the trust, using that new number.
Step 6 is the big one, transfer assets. This is when the property, the shares, the cash actually moves.
And this is the moment that can trigger that immediate tax bill we'll talk about. It has to be perfectly coordinated with your accountant.
And finally, step 7, set up compliance, which is just getting ready for the annual paperwork.
The annual T3 tax returns, the trustee meeting minutes, the ongoing work.
Okay, the big question, dollars and cents. What's a realistic budget for just the setup costs?
The range is pretty wide. You should probably budget for somewhere between $2,500 to $15,000 CAD.
That's a huge range. What drives the cost from one end to the other?
It's all about the complexity of the assets you're putting in. A simple trust with just cash or some mutual funds, that's going to be on the low end, maybe $3,000 to $5,000.
But if you're a business owner putting in shares of your private company,
Then you're heading straight to the high end, $10,000 to $15,000 easily.
why is that so much more complex?
Because holding shares of a qualified small business corporation, or QSBC, requires extremely specialized legal clauses in the deed. And your tax advisor has to spend a ton of time verifying that the shares actually qualify for that status.
And there's another hidden cost there, isn't there? Valuations.
Yes, for any non-cash asset, like real estate or private shares, you need a mandatory third-party fair market value appraisal, a professional valuation.
And that's not cheap.
No. A business valuation alone could cost another $5,000 to $15,000 on top of the legal and accounting fees. You need it as proof for the CRA.
Okay, that's the setup. What about the ongoing year-after-year costs?
You can't just set it and forget it. You have to budget for $1,000 to $5,000 CAD annually for compliance. That's for the T3 tax return preparation and the professional oversight.
So that brings up a threshold question. If my estate is, say, $1 million in GICs, is a trust worth it?
Probably not. The $2,000 annual fee will eat up any probate savings you might have had pretty quickly. A trust really only starts to make economic sense for multi-million-dollar estates, or when you desperately need those non-tax benefits, like control or asset protection.
So we've covered the structure, the why, and the cost. Now we have to get into the really tricky part, the minefield. The CRA's anti-avoidance rules.
This is where the real expertise is required. These rules are designed to stop people from using trust just to dodge tax.
Let's start with the one that shocks people the most. Trap 1, deemed disposition on funding.
This is the immediate cash crunch. When you transfer an asset that has grown in value, like a stock portfolio or a rental property, into the trust, the CRA treats it as if you sold it.
Even though you didn't get any money.
Exactly. It's a deemed sale at fair market value, and you have to pay the capital gains tax.
Okay, give me an example. I bought a property for $500,000. It's now worth $2 million. I transfer it to my trust. What happens the next April?
You have a capital gain of $1.5 million. Half of that, $750,000, is added to your income. You could easily have a tax bill of over $350,000 that you have to pay out of your own pocket.
With no cash from the sale to pay it with, that's a brutal surprise if you're not prepared for it.
It is. You have to have the liquidity to pay that upfront tax bill. It's the first major hurdle.
All right, moving to trap 2, the attribution rules. These are designed to stop you from easily shifting income to family members in lower tax brackets.
Right. Let's start with spousal attribution. It's very strict. If you transfer property to a trust to benefit your spouse, pretty much everything is taxed back to you.
The income, the dividends.
All the income, and also any capital gains when the asset is eventually sold. The benefit is completely wiped out.
Okay, so that's a dead end for income splitting with a spouse. But there's a really important nuance when it comes to minor children, isn't there?
A huge one. This is the key. If you transfer property for a child under 18, only the income, like interest and dividends, is attributed back to you. The capital gains are not.
So if I put a high-growth stock that pays no dividend into a trust for my 16-year-old,
And the trust sells it 2 years later for a big profit.
that profit, that capital gain, is taxed in the child's hands at their much lower tax rate, not mine.
Correct. So for minors, the strategy is always to fund the trust with growth-oriented assets, not income-producing ones. Once they turn 18, all the attribution rules for them stop completely.
Which brings us to a more recent trap. Trap 3, the TOSI rules, or tax on split income. This really changed the game for business owners after 2018.
It did. TOSI was expanded to stop business owners from sprinkling dividends through a trust to family members who weren't actually involved in the business.
And the penalty is severe.
It's crushing. If the income is caught by TOSI, it's taxed at the highest possible personal rate, around 53%. It completely negates any tax savings.
So the goal is to prove the income is legitimate by meeting one of the safe harbors. What's the main one?
The excluded business test. The beneficiary has to be actively engaged in the business, working an average of 20 hours a week or more, and you need to be able to prove it with timesheets and records.
So my adult child who just sits on the board in name only, their dividend would get hit with that 53% tax.
Almost certainly. There are other tests, like owning 10% or more of the shares or receiving a reasonable return for your contributions if you're overcome 4, but the 20-hour rule is the clearest path to safety.
Okay, that brings us to the final looming threat, the big one. Trap 4, the 21-year rule, the ticking clock.
You have to treat this 21-year anniversary like an unavoidable deadline. It's the CRA's way of preventing trusts from deferring tax forever.
What happens on that 21st birthday?
The trust is deemed to have sold all of its capital property at fair market value, again, a deemed sale.
So let's say a trust holds private company shares. They were worth $1 million at the start. 20 years later, they're worth $6 million. What's the tax bill in year 21?
The trust has a deemed capital gain of $5 million. It has to pay tax on that, which could be well over $1 million. And it has to find that cash from somewhere because it hasn't actually sold the shares. It can make the trust insolvent.
So you have to plan for this years in advance. What is the mandatory escape hatch?
It's called a tax-deferred rollout.
Yeah.
Before the 21-year deadline, the trust can distribute the appreciated assets directly to the beneficiaries.
In kind, as they say.
In kind. This transfer happens at the trust's original cost base, so the trust itself doesn't trigger the gain. The tax liability is essentially transferred to the beneficiary. They get the asset with the built-in historical gain, which they'll pay tax on, only when they eventually sell it.
So you're not eliminating the tax, you're just deferring it and moving it from the trust to the individual.
Precisely. It's a critical and mandatory piece of long-term trust management.
Okay, despite all those traps, there are a few situations where a trust isn't just useful, it's indispensable. Let's talk about the absolute killer app for entrepreneurs, LCGE multiplication.
This is, without a doubt, the single biggest reason for a business owner to set up a trust. The Lifetime Capital Gains Exemption, the LCGE, lets you shelter over $1 million in gains, tax-free, when you sell your small business shares.
And if you own the shares personally, you only get one exemption.
But if a trust holds the shares, when you sell the business, the trust can allocate that capital gain out to multiple family members, your spouse, your adult children, and each one of them can claim their own $1 million exemption.
So on a $4 million gain.
If you have 4 eligible beneficiaries, you can use 4 exemptions. You can make that entire $4 million gain completely tax-free. It's a multi-million-dollar tax saving. It justifies every penny of the trust's cost.
But the key is you have to do it in advance, right? You can't set up the trust the week before you sell.
No, there are holding period rules. You generally need the trust to have held the shares for 24 months before the sale. It requires foresight.
Okay, a completely different use. The Henson Trust for a disabled dependent. Why is that so important?
It's about protecting their eligibility for government benefits. Provincial programs like ODSP are income and asset tested. If a disabled person inherits a large sum of money directly, they can be cut off from those essential benefits
But the Henson Trust avoids that.
by being fully discretionary. The beneficiary has no legal right to demand the money, so the assets in the trust don't count as their assets. The trust can then supplement their care, pay for extras, without jeopardizing their core government support.
And finally, what about blended families? They're so common now.
Trusts are a perfect solution. A spousal trust can ensure your new spouse is cared for the rest of their life. They get the income from the assets, they can live in the house, but the trust guarantees that when they pass away, the capital goes to the children from your first marriage.
So it prevents the capital from being accidentally diverted away from your kids.
It provides certainty and peace of mind for everyone.
Okay, so this leads to the final comparison. If a trust is so powerful, do you even need a will anymore?
Yes,
Yeah.
100%. They are partners. A trust is for managing assets, but a will has a few critical jobs that a trust simply cannot do.
And the single biggest one is?
Naming guardians for your minor children. A trust cannot do that. Only a will can. For any parent with young kids, a will is absolutely non-negotiable for that reason alone.
So for any complex estate, the answer is you need both.
You use the trust for the major assets, for control, and for tax planning. And you use a will as a safety net, and most importantly, to appoint those guardians.
This has been an incredibly thorough deep dive. We started with the legal structure. We talked about the very real costs, that $2,500 to $15,000 setup, plus the annual overhead.
And we walk through those 4 huge tax traps: the deemed disposition, the attribution rules, the TOSI rules for businesses, and that ticking clock of the 21-year rule.
I think the biggest takeaway here is that a trust is not a passive tool. It's a dynamic, high-stakes legal structure that needs constant professional management.
That's the key insight. They are bespoke instruments. You can't use a cookie-cutter approach. The biggest mistake people make is not having a coordinated team, a lawyer and a tax accountant working together from day one and every year thereafter.
Which brings us to our final provocative thought for you to consider. Is the absolute control and the incredible tax-saving potential really worth the high annual cost and the constant planning that's required to manage that 21-year clock for your family's future?
And for those of you who are ready to explore this, who think this might be the right fit, we do want to provide a specific resource. Muneris Financial Services specializes in exactly this kind of complex wealth planning.
You can reach them directly. The cell number is 778-898-3202.
That's 778-898-3202.
The email is mansour@muneris.com.
And their website is www.muneris.com. And I think walking into that conversation armed with what we've discussed today, understanding the costs, the roles, and especially those tax pitfalls, is the absolute best first step you could take.
Thank you for joining us for this deep dive. We hope you feel better equipped to tackle the Mount Everest of estate planning. We'll catch you on the next deep dive.